trying to keep up with financial regulations, it can sometimes feel like you're juggling, I don't know, way too many things at once, right?
Absolutely. Information overload is a real thing.
Yeah, and just when you think you've got a handle on it, something changes. So today we're going to put a spotlight on some pretty important updates from the Dubai Financial Services Authority, the DFSA, specifically looking at prudential regulation.
That's right. We're taking a deep dive into what came out of their consultation paper number 161, CP 161. That first appeared back in October 2024.
Okay.
But really, our main guide for today is the feedback statement the DFSA put out just this past May 2025, because that's where they've summed up the feedback they got and, crucially, laid out their final policy decisions.
So this is basically the decoder ring. We're aiming to pull out the biggest changes and, figure out what they actually mean for firms operating under DFSA rules.
Exactly. What does it mean for you?
And it's worth saying, these changes aren't all happening at once. It's a phased thing. Some kick in July 1st, 2025. And others follow a year later, July 1st, 2026. So, okay, let's dig into the first big one.
Okay, first up is the removal of the expenditure-based capital minimum, the EBCM.
Right.
Now, this is quite a big deal for a specific group of authorized firms, AFs. We're talking about firms that control assets, maybe managing investments, arranging deals, that sort of thing.
Okay.
But crucially, they don't hold the client assets or insurance monies themselves or safekeep fund property.
So if you're controlling but not holding, the EBCM might be disappearing for you soon. July 1st, actually.
That's the date, yes.
Now, I saw that some people responding to the consultation actually thought, maybe keep the EBCM for all Category 3 firms. Why did the DFSA decide against that?
Well, it seems the DFSA's thinking here ties into this broader shift. They're moving towards a more, let's say, activity-focused approach.
Okay.
Their view is that the EBCM was mainly about having enough capital for an orderly wind down, shutting the doors properly. But now they're putting more emphasis on this new activity-based capital requirement, the EBCR, to cover the risks of the firm continuing to operate. It's going concern risks.
I see. So different tools for different risks.
Pretty much. By keeping the EBCM focused on firms that physically hold client money or assets, they're trying to tailor the rules more closely to the specific risks those firms pose. It's about proportionality.
That makes sense. More tailored.
Yeah.
And you mentioned this links to global trends. Was there talk about the EU's rules, the IFD-IFR?
Yeah, they did touch on that. It's clear the DFSA looks at what's happening internationally, like with the EU's investment firms directive and regulation.
Right.
But they were also clear they aren't just copy-pasting it. They're aligning where it makes sense for the DIFC for their specific market, but adapting it rather than just transposing the whole thing.
Okay, adapting, not adopting wholesale. Got it.
Yeah.
Now, even if EBCM is going away for some, liquidity is still key, right, for these Category 3 firms?
Oh, absolutely. Even without the EBCM applying, these AFs in Category 3 still need to hold liquid assets. And the amount has to be equal to or greater than their base capital requirement, the BCR.
So the BCR is like the absolute floor.
Exactly. The bare minimum capital needed just to be authorized. This liquidity requirement is an extra layer, ensuring they can meet short-term needs. It all links back to that fundamental rule. Have enough good quality capital, specifically common equity tier 1 capital, above your BCR.
Right. So capital is the foundation, liquidity is the readily available cash on top.
You could put it that way, yeah. Safety net and rainy day fund.
And speaking of that fund, the definition of liquid has been widened a bit.
Yes, and that's likely welcome news for many. Previously, it was mostly US dollars and AED. Now they're adding British pounds and euros to the list of eligible currencies for these liquid assets.
Which makes sense in an international hub like the DIFC.
Exactly. Firms operate in multiple currencies, so having that extra flexibility in managing their liquidity buffers is, well, just practical.
Definitely practical. But they didn't go as far as some suggested, right? Like including certain ETFs or securitizations. Why draw the line there?
Yeah, the DFSA pushed back on those. They cited concerns about, well, liquidity risk and market risk.
Meaning they might be harder to sell quickly?
Essentially, yes. There are worries that some specific ETFs or securitized products might not be reliably easy to convert to cash, especially if markets get choppy. So for these core liquidity requirements, they felt those assets didn't quite meet the high bar for stability and immediate availability.
Okay, sticking to the highly liquid stuff for the baseline makes sense. Let's talk about this new thing then, the activity-based capital requirement, ABCR. Who does this actually apply to?
So the ABCR is coming in specifically for Category 3 AFs, but
Right.
not all of them, only those carrying on a specific list of financial services.
And they've listed them out.
Yes, it's an exhaustive list. Let's see. It includes dealing in investments as agent, managing assets, managing certain types of investment accounts, managing collective investment funds, though not pure venture capital funds, that's an exception.
Also providing custody, providing trust services, acting as the trustee of a fund, and operating an alternative trading system.
Quite specific. So if you're Category 3 and do any of those, the ABCR is something you need to prepare for.
Right.
And I remember reading about K factors, KUM and KCOH. What are those about?
Right. The K factors are how the ABCR is calculated. They're meant to be proxies for different types of risk.
Okay.
So KAUM is linked to assets under management. That reflects the scale risk in managing client money.
Makes sense.
And KCOH is tied to client orders handled. That's more about the operational risk involved in processing transactions.
Got it. So the calculation depends on the scale and type of your activity.
Precisely. Tailoring the capital to the activity.
And this doesn't actually start until July 2026. There's a lead time.
That's right, a one-year transition. The ABCR requirement itself comes into force July 1st, 2026.
And the DFSA is encouraging firms to talk to them beforehand if they're unsure about how these K factors apply. Yes, definitely. They've explicitly said that firms should reach out to their supervisory contacts if they need clarification on calculating KAUM or KCOH for their specific business, which is helpful, gives firms time to prepare.
Good to know. Now, the feedback statement mentioned another factor, KDTF, daily trading flow. Why wasn't that included for these Category 3 firms?
Good question. KDTF is part of the EU regime, you're right, but it's really designed for firms doing proprietary trading.
Trading with their own money.
Exactly, trading on their own account. Since CP 161, and these changes are focused on Category 3 firms doing agency business, asset management, custody, and so on, KDTF, which targets that specific prop trading risk, just wasn't relevant for this particular group.
Okay, so ABCR is specifically tuned for the risks of these Category 3 activities. So putting it all together, for a firm subject to this, what's their overall capital requirement? Is it BCR plus ABCR plus EBCM?
Not quite added together. It's the highest of the relevant requirements.
Okay.
So, for a Category 3 firm that falls under the new ABCR scope, their minimum capital requirement will be the highest figure out of their base capital requirement, BCR, their expenditure-based capital minimum, EBCM, if it still applies to them after July 1st.
Which for many, it won't.
Exactly. And the new activity-based capital requirement, ABCR. Whichever of those applicable numbers is the biggest sets their floor.
Right, highest of the three. And what about Cat 3 firms not doing those specific ABCR activities?
They carry on as before. The DFSA was clear that if a firm's specific prudential regime wasn't changed by CP 161, their existing rules continue to apply.
Okay. And if a firm does, say, 2 activities from that ABCR list,
Yeah.
how does that affect the base capital requirement part?
The BCR isn't cumulative based on multiple activities within the same category. The rule is your overall BCR is set by the single financial service you're licensed for that has the highest allocated BCR amount.
So you look at all your licenses, find the one with the biggest BCR number, and that's your BCR.
That's the one. Simplifies things a bit.
It does. Okay, another shift involves firms dealing in investments as matched principal. They're moving category from 3A to 2.
Yes, that's happening. The DFSA described this mainly as a technical realignment.
Technical realignment, meaning
Essentially, they want a clearer separation between categories 3 and 4, which generally have more proportionate, lighter touch rules in categories 1, 2, and 5. Those latter categories are more aligned with the international Basel regime for banks.
okay.
So moving matched principal dealers into category 2 fits them into that Basel-aligned bucket, conceptually at least.
But that sounds like a huge jump in requirements potentially. Are they suddenly facing full banking-style capital rules?
No, and that's a key point the DFSA made. For now, these firms will stick to their existing risk-based capital calculations, their BCR, their EBCM. Business as usual in terms of calculation methods.
Sure.
And importantly, the DFSA has specifically amended rules to carve them out from certain standard Category 2 requirements, things like the capital conservation buffer, strict leverage ratios, detailed interest rate risk rules. Those won't automatically apply to these firms moving from 3A.
So it's more like changing the label on the door for now, but not fundamentally changing the room inside just yet.
That's a good way to put it. It's a recategorization.
That
Although,
one.
the DFSA did signal that they plan to review the Prudential regime for all Category 2 firms more broadly in the future. So while it's status quo on calculations now, it flags that Category 2 might see further evolution down the line.
Okay, something to keep an eye on. Let's switch focus again. Internal assessments, IRAP, and IKEAB. What's changing there for Category 3 firms? Seems like a theme emerging.
It does, doesn't it? Following what they did for Category 4 firms earlier, the DFSA is now removing the mandatory requirement for Category 3 firms to conduct and document a formal internal risk assessment process, IRAP, and an internal capital adequacy assessment process, ICAP.
So less paperwork mandated.
In terms of those specific processes, yes, it aligns with that goal of proportionality, reducing prescribed requirements for firms where they perhaps see the overall risk profile as lower or different.
Let's hang on. Does this mean firms can just stop assessing their risks or figuring out if they have enough capital? That sounds, well, risky.
No, definitely not. And the DFSA was very clear on this. While the mandate for those specific IRAP documents is gone for Category 3, the DFSA absolutely retains the power to impose individual capital requirements or indeed liquidity requirements on any firm in any category if they have specific concerns about that firm's risk profile.
Ah, okay. So they still have a supervisory tool if needed.
Exactly. It's a reserved power. They even mentioned further guidance is coming on how they might use this power.
And if they were thinking about imposing extra requirements on a firm, they'd talk to the firm first.
Yes, the process would involve discussion with the authorized firm. It wouldn't be out of the blue. They'd engage to understand the firm's specific situation.
And I suppose they can't really give examples of when they might do this or how much extra capital they might ask for.
No, they stated they couldn't provide specific scenarios or ranges. The reason being that firms are so diverse, business models vary hugely, and the specific risks are unique to each firm. So any intervention would be very much tailored to the individual case.
Right. Bespoke supervision based on risk. Okay. Professional indemnity insurance, PII. Another area of change.
Yes. For those AFs that are going to be subject to the new ABCR, the proposal is to remove the mandatory PII requirement.
Okay, so if ABCR applies, maybe no PII needed.
Potentially, yes. But, and this is important, PII will still be mandatory for certain firms, specifically insurance intermediaries and managers, and also financial advisors and arrangers.
Right, where that direct client advice or intermediation role is central.
Exactly, where that specific type of client protection from PII is deemed most critical.
So, again, a more targeted approach.
Yeah.
And the length of the cover required, that changed too.
It did. The original idea was continuous cover. But based on feedback about what's practical and available in the insurance market and proportionality, they've landed on requiring PII cover for a period of 4 years rather than indefinitely.
4 years. Okay, that sounds like a pragmatic adjustment. Right, we've covered a lot of detail. Let's just quickly recap the timing again. Phased implementation.
Yes. 2 key dates. July 1st, 2025. That's when the changes aimed at reducing burden come in, like the EBCM removal for certain firms, the broader currency list for liquidity.
Okay, phase 1, easing measures.
Then July 1st, 2026, that's phase 2. That's when the new requirements land, primarily the activity-based capital requirement, ABCR, and the updated PII rules.
Got it. So between July 2025 and July 2026, some firms might actually see their required capital temporarily decrease if EBCM goes away, but ABCR hasn't arrived yet.
That's a possible scenario, yes. The DFSA acknowledges this potential temporary dip.
And what do they expect firms to do? Just enjoy the lower requirement for a year?
Not exactly. Their expectation, really, is that firms will manage their resources prudently through this period. They know the ABCR is coming in 2026, so the message is, plan ahead, make sure you're building or maintaining the resources needed to meet the full requirement when it bites in July 2026. Don't treat the temporary debt as a permanent reduction.
Sensible advice, responsible playing. And for reporting this new ABCR, firms will get guidance. Templates, instructions.
Yes, the DFSA confirmed they'll publish the reporting templates and detailed instructions for the ABCR. That will all happen via their online system, the EPRS.
Okay.
And they also plan to engage with the firms affected well before the first mandatory submission, which will be for the third quarter of 2026. So firms should get support on how to do the reporting.
Good. Okay, let's try and pull this all together then. What's the big picture here? What are the main takeaways from all these DFSA changes?
Well, I think the overarching theme is definitely a move towards more risk-sensitive regulation
Mhm.
and proportionality.
Tailoring things more.
Exactly. Removing the EBCM where it's less relevant, bringing in the ABCR based on specific activities, tweaking liquidity, adjusting PII, it all points to the DFSA trying to align the prudential requirements more closely with the actual risk different types of firms are running in the DIFC.
It certainly sounds like anyone operating in the DIFC needs to, really understand how these changes affect them, especially with that first July 2025 date coming up quite soon.
Absolutely critical. And, for you listening, even if you're not directly regulated by the DFSA, watching how a major financial center like this evolves its rules, it gives you real insight into the global regulatory conversation, this constant effort to strike the right balance.
Balance is the key word, isn't it?
It really is.
Yeah.
Balancing financial stability and robust oversight with not creating unnecessary burdens that stifle business and innovation.
So maybe a final thought for everyone to chew on as they process this. In today's really fast-moving, interconnected financial world, how do regulators like the DFSA keep their rules effective and relevant? How do they adapt without either falling behind or overreaching? It's this constant tightrope walk, and these changes we've discussed are, well, one example of navigating that challenge.